about gold and platinum? You have to hedge it. Well, the prices continue to go higher on the margin account, which has forced all the speculators out of COMEX, but it's really did a number on this industry for right now, where premiums are very disconnected. They're high buy prices and low bid prices. I've never seen this in 36 years. Never, ever. Nothing like it. It's just a weird time where someone is betting that
Why would they do that?
They did a call spread between 15,000 and 20,000 by the end of the year. Someone's betting that gold ends up 3 times higher than it is today by December. Either you got a lot of money just to piss away, or you know something that others don't. And it's when you look at it on a chart, it stands out like a sore thumb. It really does. Like, you can see just this huge level of interest into December between 15 and 20,000.
Soaring margin requirements in gold and platinum markets are squeezing liquidity and forcing speculators out of the COMEX, creating historically wide bid-ask spreads. Industry veteran Andy Schectman says he has never seen premiums so disconnected in 36 years. Meanwhile, an eye-catching December call spread between $15,000 and $20,000 suggests a major player is betting gold could triple before year-end. Such unusual options activity stands out on the charts, fueling speculation about monetary instability, potential dollar weakness, and a possible gold repricing event that could reshape global markets if confidence continues to erode. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Someone is betting that
Why would they do that?
They did a call spread between 15,000 and 20,000 by the end of the year. Someone's betting that gold ends up 3 times higher than it is today by December. Either you got a lot of money just to piss away, or you know something that others don't. And it's when you look at it on a chart, it stands out like a sore thumb. It really does. Like, you can see just this huge level of interest into December between 15 and 20,000. Someone's betting that gold ends up 3 times higher than it is today by December. Either you got a lot of money just to piss away, or you know something that others don't. And it's when you look at it on a chart, it stands out like a sore thumb. It really does. Like, you can see just this huge level of interest into December between 15 and 20,000. Could that happen? I've been saying for a very long time, I believe that the dollar, they want to default on the dollar standard. It's the only way, not only to pay down the debt, but to ever have any intention, as we've talked about before, to reshore manufacturing. And Judy Shelton's theory comes into play on the backside of that, the Genius Act, which is the movement of money via stablecoins that goes into effect early next year in January. All of these things come into play to achieve what I think they're trying to do. But yeah, I mean, whether they revalue it outright, where the government says, gold is now revalued the way that Roosevelt did in 33, or Nixon did in 71, 72 and 73. He closed the window at 35, revalued it to 38 in 72 and to 42.22 in 73. In both instances, the dollar was devalued, just like Roosevelt did, paid everyone $20.67 on a $20 gold coin, with a dozen eggs being a nickel. 67 cents was great. And then he immediately devalued the dollar by 40, making gold $35. So could we see a period of time where the government independently revalues gold? A lot of people think that can happen. In fact, most central banks on the planet keep gold in what's called the gold revaluation account. Is it a possibility? Sure. I think it's probably even easier to let it move up organically before they revalue it. And maybe that's when they plan on doing it, right leading into the beginning of the year, the Genius Act. I don't know. But all I can tell you is that someone or some people or some entities have placed a very large bet that gold will be between $15,000 and $20,000 in December. It will be interesting to see how that all plays out. The refiners, with the continual increase in margin costs and the rising price of silver, for the last few months, has shut down every refinery because they're getting margin calls. If they have 50 million in inventory that they've paid the public, they have to hedge 50 million. In other words, they sell short. And so they're market neutral, but it takes so much time to process what they're refining that they're not even breaking it down or melting it down yet before their margin. And so it shut down a massive source. The small dealers like your local coin shops who don't hedge, if they take in 100 grand of silver eagles and the price of silver falls by $8 like we've seen, these big moves up 8, down 8, which we never would have dreamed of, right? I remember telling Kevin, who works for me, that you will see days of multiple dollar increase. It's like, well, it never moves up more than $1. Well, true. Now we are. And I think we'll see that even to a much greater extent as real price discovery comes into play. But these refiners were margin called, shut down. And the small companies, small dealers who don't hedge, if you buy it and pay spot and it falls by $8 on 100,000 worth of silver and 1,000 ounces, you're down $8,000. You're not going to get back. You make a fraction of that when you sell silver. And so the point of it is that the small dealers who don't hedge have to be way back a spot. The dealers that are hedging, a week or two before Christmas, if we typically have 2 million ounces of silver in a warehouse and we hedge it with futures contracts, a few weeks before Christmas, it was about $17,000 to hedge 5,000 ounces to buy a contract, one futures contract, 5,000 ounces. Now it's almost 50,000. The cost has gone up so much that even the big companies like ourselves, if you don't have 50 million bucks in your margin account, you're not holding a big inventory. And that's just silver. What about gold and platinum? You have to hedge it. Well, the prices continue to go higher on the margin account, which has forced all the speculators out of COMEX, but it's really did a number on this industry for right now, where premiums are very disconnected. They're high buy prices and low bid prices. I've never seen this in 36 years. Never, ever. Nothing like it. It's just a weird time.
A massive December call spread between $15,000 and $20,000 is turning heads in the gold market, signaling that at least one major player expects an explosive rally. Market insiders like Andy Schectman point to unusual options activity and rising margin costs on the COMEX as evidence of mounting stress. Refiners and dealers face soaring hedge expenses, while liquidity tightens across silver and gold markets. With historical precedents like Franklin D. Roosevelt and Richard Nixon revaluing gold, speculation is growing that a currency reset or organic repricing could push gold dramatically higher. Let's get back to the interview.
The global trust in the US dollar is slipping, and it's a top risk and he cites that the dollar share of global forex reserves has fallen to just about 55% from 70 in years past, and the dollar's drop is to the benefit of gold, the euro, and the yuan as they are rising. He cites it as a direct signal that the markets are diversifying away from the dollar. He also went on to say that Fed rate cuts are not optional, that they're a key tool to steady markets and confidence. And look, this is a situation where, the dollar system is based on confidence, Jared, and the confidence is gone in many ways. And so on one hand, you look at what China is doing. They just told their large banks to stop loading up on U.S. treasuries, in fact, to trim exposure on them. They are starting to treat U.S. government debt or our bonds like it's a concentration risk, not the ultimate safe haven that we've always been told. And they're speeding up their exit from the dollar and de-risking the dollar system. I think that's something from a primary standpoint that people need to understand. When you talk about what's going on with the silver market. Yeah, we knew that this was going to happen. I'll get to that in 1 second. I wanted to talk about also David Einhorn, the billionaire who thinks gold is already on its way to becoming the world's ultimate reserve asset, that it's starting to replace the treasuries. You're getting guys like Ray Dalio and now David Einhorn saying these things out loud. He cites the central bank buying, as we've talked about forever, and that almost 80% of reserve managers see that gold will be a higher share of reserves 5 years from now. So the macro side of things still looks very good. And when you talk about what's going on with silver, they had to try and do this. We're 10 days away, Jared, from first notice day on the March silver contract. And people need to understand what this means. I haven't looked yet today because we won't get that information until tomorrow or the next day, but open interest as of Friday was still at just under 59,000 contracts. I think it was 58,770 contracts. And each contract is 5,000 ounces of silver. So that's 294 million ounces of silver still open in March, meaning that they could stand for delivery if they wanted to. I just heard my phone got off. So they could do that. And look, a bunch of it is rolled to May because last week it was 400 million ounces that were still open. But and that's normal, right? A lot of it will roll to the next big delivery month, which is May, not April. But it's still, to have this huge of an open interest this close to the first notice is noteworthy. If even half of that open interest actually decided to stand for delivery, you're talking 147 million ounces that would need to get sourced. And the interesting thing about this is that the registered silver, the metal that is actually available to deliver, is around 90 million ounces. So do the math. Demand for delivery spikes. COMEX has two options: either drain the registered inventory fast or force incentives like higher premium or roll pressure, meaning we want you to cash settle or roll it into the next month, and we'll give you a premium, a carrot, let's call it, to do so. We'll pay you extra money to settle in cash or to roll it forward. And this is how stress shows up, not in the price. It's in the delivery mix, and that is what we're seeing. And the market stays calm until it doesn't. So when if even 20% of that silver stands for delivery, that's 50 million ounces with a 90 million ounce registered category. It's putting serious stress on the market.
Global confidence in the United States dollar is eroding as its share of global reserves falls, benefiting gold, the euro, and China's yuan. Investors like Ray Dalio and David Einhorn argue gold is steadily replacing treasuries as the ultimate reserve asset, fueled by aggressive central bank accumulation. Meanwhile, rising open interest in silver futures on the COMEX highlights mounting delivery stress. With registered inventories near 90 million ounces against far larger potential claims, even partial delivery demands could strain the system, reinforcing bullish long-term fundamentals for precious metals. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.